You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions@TheOptionsInsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, Characteristics and Risks of Standardized Options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started with industry happenings.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
In today's industry happenings, we're going to analyze stock splits. Especially in an up market, stock splits can be a fairly common occurrence. There can be a lot of moving parts when this happens, so let's look at some of these things you should be watching out for. Of course, know what the stock split will be. Is it 2-for-1, 4-for-1, or even the popular 7-for-1, and so forth? Now, a 2-for-1 split means after the split date, you'll now have twice the number of shares you had, but with half the price. For example, if you owned 100 shares of $100 stock and it splits 2-for-1, you'll have 200 shares of a $50 stock after the split. Knowing the details of the corporate announcement is very important. Let's look at the option side. If you own 10 100 strike calls in this $100 stock, after the split, typically you'll own 20 calls of the now adjusted 50 strike. That's the most common way options change on a split announcement, but there can be exceptions. So please do pay attention to the announcement details that come from OCC. Our investor services group specializes in a lot of different things. Stock split announcements and corresponding option adjustments are probably close to the top of their list. Always reach out to them at 888-OPTIONS or via email with all option-related questions. Now, a potential wild card that comes into play after stock split announcements is the level of implied volatility in the options. Sometimes implieds vol expand, and yet other times they contract. In my experience, I've seen implieds expand far more frequently after a stock split than go the other way. Now, you can always check the implied volatility charts under Tools and Resources at optionseducation.org. They are labeled historical and implied volatility in the dropdown. So remember, with a stock split, know the split details, know how the option strike price get adjusted, know how many options you have in position before and after the split, and be aware of changing implied volatility levels. That's today's industry happenings.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining us today on Strategy Spotlight is Sean Howe of Pro Market Advisors. Welcome, Sean.
Good morning, Joe. Thanks for having me on today.
Great to have you. Now, before we talk about today's topic, which you chose, calendar spreads with index options, tell me a little bit about the Pro Market Advisors and then, some of your experiences in this business.
Sure thing, Joe. Well, I've been in the industry for about 20 years now. Started off with Charles Schwab back in 1995. I moved to Thinkorswim in about 2005, and then during the merger between Thinkorswim and Ameritrade, sort of set me adrift. So I started working with one of my friends, Rick Swope, back from my Charles Schwab days, and we wanted to create a firm, and that was Pro Market Advisors, that was strictly about education, primarily education around technical analysis, trading, and sort of my expertise, which is really about option trading and utilizing strategy. So really our firm is about education and consulting, and we have a number of phenomenal partners, Options Industry Council being one of them, E-Trade being another, Bank of Nova Scotia's iTrade unit, and also our publisher, which is Wiley Trading. So we're really about education.
Well, you do a great job for us. I know it's some of the investor education days. Now, you mentioned Schwab. You obviously had some experiences before you and Rick got together. Tell me a little bit about that.
Sure. I've been in the industry just about 20 years now. In fact, it started way back in college where I interned at Shearson Lehman Hutton. I did that for about a year and a half to see if that was really what I wanted to get into. And to be frank, that just wasn't quite the right environment for me. It was more about selling than it was about managing assets, I felt. So I went into grad school, and then I went and actually taught English in Japan for 2 years. And after coming back from Japan, I still sort of had this itch that needed to be scratched to learn more about the stock market. So I joined Charles Schwab in 1995. I really didn't know anything at all. My time at Shearson hadn't taught me much. In fact, I still remember being chastised by a client for not knowing the symbol for IBM. I started at $8. Yeah, I'm a little ashamed to say, but everyone has to start somewhere. I started at pretty high wage, $8.11 an hour, as a temporary quoter back in the Schwab days. But it fascinated me enough. Was that before or after
taxes?
Well, I still remember that if I did more than 10 hours of overtime, I could get double time and pizza. So I did a lot of the double time hourage to get to that point. Yeah, so those were some interesting days. I was with Schwab for about a decade. In fact, that's where I met Rick Swope. That's where I met my business partner. And we both had a passion for working with clients. We did a lot of working with hedge funds, working with very active traders, and a lot of that involved educating them on our products and services, but also just educating different traders on different strategies that we had learned along the way as well.
Well, we're thrilled to have you here today. And as I said earlier, I'm interested in today's topic, especially because you chose calendar spreads, but calendar spreads with index options. Why'd you pick that?
Yeah, so the calendar spread is a strategy that I really enjoy teaching to people, but it seems that when you talk about calendar spreads related to options, it creates too much anxiety. And what I found is that anxiety leads people to emotional trading, and emotional trading leads to generally bad trading. So using an index option, as we get into this, I think it'll become a little bit more clear for the listeners. But using an index option simplifies things and takes a lot of the decision making off of the trader, him or herself. So it simplifies it, although one would think that because it's an index, it's going to be more complicated. Actually, it's not. It's going to be a simplified version of using calendar spreads, be it either horizontal or diagonal.
Yeah, well, let's hone in on that because I'm with you. I think, a lot of investors and some professionals, when you start talking indexes, the eyes glaze over and there's that kind of fear of intimidation. So why don't we start by focusing on index options themselves? Are they different from your standard equity options? And if so, how? Let's get into that.
Yeah, there's a couple of primary differences. So the main difference is that when you are doing an equity option, that there is something that can be delivered. So if it's 100 shares of XYZ, so it's a one contract position, 100 shares of XYZ, that 100 shares can be delivered in between the buyer and the seller of the call or the put. So there can actually be sort of a physical transaction that takes place. Whereas if you're looking at an index option that could have anything from a couple of hundred to even a couple of thousand individual positions that are contained in that index, there's really no possible way for there to be a physical transaction or physical delivery of the shares. And even if there was, so many of those shares would end up being fractional shares. So instead of a concern about a physical delivery of the shares between clients or between brokers, we're really talking about something that is cash settled. So at the expiration date, if there's any money that is due either party, it's simply settled up in cash. So the cash settlement tends to bring a lot of clarity to the individual trader, and it really simplifies things overall because of that.
And is that the case with all index options?
It's generally the case with the vast majority. When you get into some of the narrow-based index options that have maybe a couple of dozen of individual positions in them, there can be physical delivery there. So it's always best that you check either with your broker or you check online or you check with the exchange that has listed those options to determine, is this going to be a cash settled or is it going to be settled in shares?
Okay, great point. How about the type of exercise? American, European, and maybe just for clarity's sake, explain each.
Sure, absolutely. So let's explain what each of those are. American and European have absolutely nothing to do with regions, continents, have nothing to do with that. So throw that out just for a minute. European and American really have to do with the rights and the obligations. So a person that has bought an equity option, and by the way, all equity options are going to be American style. So the person that's bought an American style option, they can exercise their right to those shares at any time during the life of that option. And that means they can exercise that right even if it doesn't make any type of financial sense. They still have that right to do it. So for the person that sold a covered call, let's say on an individual stock position, they may be wondering, when will this person exercise their right and I'll take an assignment and have to give up my shares? And that really can happen at any time. With European settlement, the exercise or the assignment on the other end can only happen at expiration. So there is no risk or no concern about an early assignment. There's no concern about possibly the shares being taken away prior to a dividend X date. So again, it brings with it some clarity that nothing can happen as far as the exercise and the assignment until expiration. Now, when I explain that to people, sometimes they misunderstand and they think that if they're in a longer term European style option, let's say it's a year, 2 years, or 3 years, they think they can't do anything with it during that period. And that's not true at all. Like all listed options, these are very tradable entities, so they can trade in and trade out, trading in for their profit, trading in or out for their loss. Regardless, they can move in and out of the position through trading. They just can't exercise the position when it's a European style option.
Sean, I'm so glad you mentioned that because, especially the retail investor, oftentimes, they put on a position and they think, well, I got to hold it to expiration. So just really thrilled that you mentioned that because that's so important. Investors can get in and out of the market at any time.
They may not like the values that they're moving in or moving out of the position, but that is the nature of the beast.
So would you say there's an advantage or disadvantage to trading index options versus equity options, or does it really depend on what the investor wants to do?
Well, I think in some ways it depends on what the investor wants to do. But generally speaking, this is sort of like having your cake and eating it too. So one of the things with working with a lot of retail investors, when people want to describe to us their ultimate strategy, it sort of sounds something like this. Hey, Rick and Sean, here's what I want to learn from you all. I want a strategy in which there is some upside growth potential. Okay, well, no problem there. But I also want you to teach me a strategy in which I get growth, but also I get some income. So I can see some money coming in on maybe a monthly basis. Okay. And then I want a strategy in which I'm not taking on too much risk either. So they sort of want their cake and they want to eat it too. And then they want to throw other things on top of that as well. And there's not any real one strategy out there that does all of those things perfectly. But by looking at a calendar spread, a horizontal and a diagonal, you do have upside growth potential. Granted, it may not be as much as if you just outright bought a long call position. You do have income potential as well. Granted, it may not be as much as a credit spread or an iron condor. And then the third thing is that you do have defined risk. And defined risk is, I can tell you with absolute certainty, if everything falls apart and your position crashes and burns, how much you could absolutely lose. And generally, it is going to be less than if you had done this with a straight equity position, simply because we're talking less dollars involved, and that'll become a little bit clearer as I provide an explanation or some examples.
Well, I'm glad you mentioned the time spread, also known as the calendar or horizontal spread, because after all, that is today's topic in Strategy Spotlight. So let's circle back to that. And by the way, I want my cake and I want to eat it too, all at the same time, just like everybody else. The calendar spread, for our listeners who are not familiar with it, why don't you lay out for them exactly what that is?
Sure. So one of the ways that I like to explain this is, let's get away from the options in the equity market for just a few minutes and explain something that I think everyone can understand a little bit more. I'll tell a quick story. Back before my wife and I had children, we'd gone to Hawaii sort of as a delayed honeymoon, and we were having such a nice time walking on the beaches of Maui. And I'd seen up on the beach a little bit, there was a for sale sign, and it was your typical for sale sign that had the little box with a brochure in it. So I told my wife, let me run up and pull this brochure. I'm real curious to take a look at what that particular condo might cost. So I went up, pulled the brochure out, ran back down, and she and I were looking at it. And this particular condo was for sale or lease, and that's kind of where this comes in. It was for sale for about $500,000 is what it came out to be, or it was available for long-term lease, and the long-term lease was something like $25,000 a year. So if you think about it, the owner, I'm going to assume that this thing was free and clear, the owner wouldn't mind selling it for $500,000, but if nobody was willing to buy it for $500,000, the owner would consider a long-term lease of 1 year for $25,000. If you think about what that owner would be getting as far as a return on his $500,000 equity position, he'd be getting 5% return. So as we were walking along the beach, I was thinking to myself, you know what? Really at this point in time, I can't afford a $500,000 condo, but I wouldn't mind doing the long-term lease. Now, if you think about it, I was a working guy at the time, as was my wife. We, at the most, had 2 to 3 weeks of vacation. So if I had leased...
You're still a working guy, aren't you?
Yeah, I'm still the working guy, right?
Okay, let's get that straight.
Yeah, exactly. Still am. So if I took a look at that and I thought, okay, if I were to lease this for $25,000 for 52 weeks, if I went back to my office place, and by the way, that was Schwab at the time, if I went back and I shared with all of my broker colleagues, hey, look at the condo that I have in Maui. Now, I'm using the word have because I would at that point in time, if I leased it for a year, I would have it for a year. I don't own it, but I have control over it. And that's very similar to what happens when you buy an option. You don't own the underlying, but you control the underlying for that defined amount of time. So I have access to this condo for 1 year. And if I do a good job of talking it up and maybe posting pictures on the company bulletin board and sharing it with friends, I may be able to rent it out over a series of weeks to my other buddies at that company there. And the going rate at that point in time was about $250 a night. So if you think about it, if I went ahead and I leased it for $25,000 a year, my cost per day is about $68.50. But if I could rent it out...
Does that include condo fees?
I'll get
I'm only
to
kidding.
that,
I'm only
actually,
kidding.
Joe.
We're not going there.
We could go deep into this, right? Insurance, taxes. So if I could rent it, or I should say, if I'm leasing it for $68.50 a day, but I am renting it out to my buddies at $250 a night, or
Somebody
to make that
you are.
Yeah, exactly. What buddy I am. Hey, I'm in this for money. They understand that. They're all brokers. My cost per week was $480, and I'm bringing in income of $2,500 a week. So if you think about what I'm really doing is I'm buying time at a discount and I'm selling time at a premium, and I'm generating profit as a result of doing that. So if you extrapolate those numbers that I just shared of $250 a night and $1,750 a week, what I'm really going to do is my ideal would be to rent up the condo for a total of 50 weeks. That would generate $87,500. Now remember, I paid for the 1 year long-term lease. I paid $25,000 for that, and I'm generating $87,500. Now notice, Joe, that I said I would only rent it out for 50 weeks. You can probably figure out what I would do with those other 2 weeks that I didn't rent it out for, right?
I got a pretty good idea.
Yeah, exactly. Those would be my 2 weeks. And of course, the extra income that it's producing would provide for plenty of meals and, of course, airfare to get over there. That's the same approach that we're going to take by looking at a calendar spread. We're going to buy more time, and as such, as I believe everyone understands, the more time we buy, the greater the discount is on that time. And then we're going to rent out our position. In this case, it would be an index position. We're going to rent it out for shorter terms. In this case, we may use an option that lasts around a week, maybe 2 weeks or so, and we're going to rent that out for a premium. And the difference between the two is how we can generate some of our profit. So clear so far on that one?
I like that a lot. And why don't we roll it into XYZ in terms of, pick a strike? I think that was a real good analogy.
Let's run into XYZ. So let's call this the XYZ 400 index. So since it is an index, it contains 400 individual positions. Those positions could be anything from large cap, small cap, mid cap. Let's just say this is a generic index in this case. So it's the XYZ 400 index. It's European style, so as I mentioned before, that means that really no one can do an early assignment, an early exercise, so there's no concern about early assignment in this case. It's going to be cash settled, which means that at expiration, everybody settles up in cash. You either receive cash or you pay out cash. And it has a multiplier of 100, which is, of course, very typical with equity options as well, that they represent 100 shares with a index option. Typically, there is a 100 multiplier there as well. So on this XYZ index, let's take a look at a 1 year 1,000 strike. That is currently the level of the index. It's trading right at 1,000. That makes the math very easy for my feeble brain when it comes to math. So the 1 year 1,000 strike, let's say, is going for per contract, let's say it's going for $4,700. Now, if you think about that for a minute, because it's a 100 multiplier, that $4,700 worth of premium to buy that at the money option really is representing $100,000 worth of the index. So it's got a decent amount of leverage here. So we buy that 1 year, we spend $4,700. Now that we have it, we need to kind of take a look at the index and how it's been moving. So just let me paint a quick picture on that as well. The past 12-month performance on this index has been pretty spectacular. In fact, it's returned about 24%, very smooth, consistent moving higher over the past 52 weeks. That's about a 0.46% return per week. So it's gradually, it's been going higher and higher, and we still have somewhat of a bullish outlook on the XYZ index. So what we're going to do to sort of rent out the condo now that we've leased the condo for a year, again, our cost on that was $4,700, is we're going to look at an option that lasts about 1 week that is just slightly out the money. Since looking at the chart, I've determined that this index has been growing at about 0.46% per week. I'm going to take a look at the strike price that is at 1,005. So it's just slightly out the money here. Good with those numbers so far?
Yeah, and always, picking the strike price is critically important, but I know you're getting into that.
Well, and that's a great point. If I wanted to make it a horizontal, so the horizontal one is basically I own the 1,000 strike that's out a year. I'm going to sell the 1 week 1,000, so they're both at the money. So it's horizontal because they're at the same level. If I sell that 1,000 strike that is out 1 week, let's just say on the premium, I can get $650. That's great considering my entire 1 year investment in this thing was $4,700 and I'm getting $650 for 1 week. That's spectacular, but because it's horizontal and they're both at the current price of the index, which is 1,000, I really don't have much in the way of upside potential. There's not a lot of growth there. What I'm really getting out of this is I'm getting the time decay, which is, of course, measured by the theta. And I know I've got positive time decay in this case here. But since I do want to have that upside growth opportunity, I'm not going to look at the at the money. I'm going to look at the one just out the money, as I mentioned, which is the 1,005. Now, if the 1,000 could earn me 650, the 1,005, let's say, can only earn me 450. It's not as good as 650, but I've got a little bit of upside potential there. Granted, it's only 5 points, but on an index that is with a 100 multiplier, that's a decent amount of money. So if I can get $450 for the 1,005, and I like the idea of upside potential, if I wanted to sell the 1,010 against the 1,000, I could get $400. So I'm giving up a little bit of premium, but I'm gaining more upside potential. So it's up to the individual trader to kind of determine, are you trying to get upside potential through the next week, or are you trying to capture as much premium as possible in the time decay? And usually as the traders kind of look at these numbers, they determine what they're most comfortable with. None of these answers is the perfect answer. They all have pros and cons. So let's say that the trader felt that this week was just going to be sort of a typical week in that the index doesn't gain really any more than about the typical 0.4% that it has over the previous year. And that trader decides to sell the 1,005. What the trader has is a calendar spread. It is a diagonal spread. Because if you take a look at that and you think about owning the 1 year 1,000 and you've sold the 1 week 1,005, if you look at that, you sort of diagram that out, it forms a diagonal is what it does. So you collect your $450, it's cash, and then at the end of the week, what you would like to happen is you would like for that index to have gained some value, but to have not exceeded, upon expiration, a value of 1,005. So for example, 1,004.99 would be the ideal level upon expiration, which would be Friday at 3 p.m. Central Time. If it reached expiration at 1,004.99, terrific. The obligation will essentially dissolve, and then you can do the same exact thing on Monday. And in that case, you might want to sell the next strike price that was about 0.5% away from the current price that it closed on Friday.
A couple things come to mind. Let's say, okay, we've got this diagonal, so we're long the 1,000 strike, we're short the 105 strike, and you're talking weeklies now. I mean, at some point I want to roll into the standard monthlies, but let's focus on the weeklies. If on Friday, that index, right before the close runs through the strike at 105, where are we? What position does the investor hold?
So let's go ahead and take a number, and let's say that Friday was a big day and the index had moved up to 1,008. If this was the case of an equity option and you were doing the same thing using equities, it would be American style in that case, and they would be settled up in shares. You would expect that you would get an assignment and you would lose the shares. So Friday would be a stressful day. You'd be wondering if you should roll up, if you should roll out, if you should just close the position, what you should do. Because this is a European-style cash settled index option, you don't have that what do I do type of thought. It's going to be very clear to you what's going to happen, and here's what's going to happen. If the index closes 3 p.m. Central Time at 1,008, everything settles up in cash. Because that index is in the money by 3 points, and the multiplier is 100, from your account, $300 will be taken. 3 points intrinsic value times the multiplier is $300. $300 will leave your account in that case. So the money has left the account, which essentially is increasing how much your total cost was. Your total cost up to that point was $4,700. Now your total cost to hold that position is up to $5,000. That being said, if we take a look at the deltas between,
let me back up. Let me back up 1 second.
Fire away,
Total cost. Okay, total cost 5,000. But in essence, I think, is this the option we sold for 650 to begin with, or?
This is the option we sold the 1,005.
Oh, for around 450, I think you said.
Yes.
Okay, so we sold it for 450. We have 300 taken out. Are we still in the red, or excuse me, in the black by 150?
We're still in the black by 150, of course, less the fees, but absolutely we're still in the black. And then there's that icing on the cake, which is the fact that since you bought the 1,000, your long-term 1-year option, and now the index is at 1,008. So now we are $8 more in the money on that. And because the longer-term option had the higher delta going into it, you have more equity more intrinsic equity built into your 1-year option. So although you had to give out 300, if you look at your equity position in that, your ownership position of that, it would have gone up more than the $300. And as you were mentioning, Joe, we also were brought in that 450, so we're still in the black in that case.
Okay, dynamite. So, all right, that's clear. Let's kind of flip it over and talk about a worst case scenario. And again, I guess we're still in the weekly, so we're long the 1,000. We're short, either the 1,000 or the 105. You pick it. What's the downside here? What's the worst case scenario?
Sure. The worst case scenario is really that the index collapses, because since you are still net long deltas, the more that it collapses. So let's say that at the end of that week, and of course you could have closed it out at any time. Let's say at the end of the week this thing has lost 10% of its value. So we'll use that number. It's at 900. Well, it's at 900, and you still have a remaining 51 weeks of your longer term option there. But because it's starting to collapse here, yes, you kept your 450, so you did not have any kind of a cash settled assignment whatsoever. But your long-term position has lost a considerable amount of value because that index has fallen so much. But again, it's defined risk. So let's take the worst case scenario. And the worst case scenario is that index goes to zero. And of course, if an index goes to zero, that's in this case somewhat broad-based with 400 stocks. There's probably other things that we're worrying about besides what's going on in our portfolio. But the worst case scenario is this is defined risk. So the most money that you could have lost on this is going to be what you paid for it, which of course in this example I'm talking about paying $4,700. However, it is not, your maximum loss is not $4,700. It's $4,700 less the premium that you brought in for that week, which was $450. So every week that you are selling this shorter term option, you are lowering your cost basis. And by lowering your cost basis, you are reducing your total capital at risk. And that's the idea that if you do this week after week or on monthlies, month after month, you are slowly driving down your cost basis. While if you're doing it properly, technically, you are increasing the overall value or the upside potential for that option as well. That's why I said earlier, you can have your cake and eat it too.
And is there any predisposition by you or an investor, whether you want to sell the weeklies or sell the standard monthlies? Any feeling there?
Great question. Let's go back to the condo example. So maybe one of the guys at work says, hey, I'm going to take a one month. I've been here for a long time. I've got 1 month worth of vacation. So tell me what you're going to charge me for the condo. If I explain to that person, well, let's see, there's 4 weeks in a month. So since I'm charging $2,500 for $1,750 for a week, it's just going to be 4 times $1,750. He would say, no way, that doesn't make any sense. If I'm going to rent it from you for a month, I expect a discount. So instead of $250 a night, I'll go ahead and I'll give you $175 a night. Sort of the same case here. If I'm going to sell a 1 month option, then I should expect to bring in less premium per day. This is why I'm using the weekly time frame here as far as my short leg for my calendar spread, because I want it to capture as much time decay and as much premium per day as I can. Granted, it's going to mean that in a 1 month period, I'm going to have to do this transaction 4 times, but my goal here is to generate as much income as possible. Doesn't mean it's necessarily the best. It's a little bit more busy with more commissions involved, but I can certainly do the 1 month. The 1 month means I'm going to bring in a larger sum of money, but that sum of money is smaller per day. So you can do either or. Happy medium could be doing an option that is out maybe 2 weeks or 3 weeks to a monthly. But again, to each his own in this case.
Well, let's see. Before we wrap up, I think I just really want to ask you any other things you want to offer our investors, either about this strategy or in terms of just educational tips.
Yeah, absolutely. Thanks, Joe. To me, this is the kind of strategy that allows people to have the flexibility that they're often looking for when you're using horizontals and diagonals. So when you're using calendar spreads, these are strategies that have utility in bullish markets. These are strategies that have utility in range-bound markets. And to a lesser extent, they have some utility in somewhat of a mild bearish market. If you're looking at a strongly bearish market, this might not be the right strategy to take a look at. But what we're experiencing so far this year is it feels to me that our broad-based indices had such a tremendous run-up last year that my expectation is that we're going to see a little bit more of a range-bound market this year. And of course, a person that doesn't have range-bound market strategies is really just going to be wasting time this year. I think this is a nice way that you can have some upside potential, very flexible, very adjustable, if you will, but also you can produce some income as well by utilizing these calendar spreads.
Excellent, Sean. Well, we really appreciate you making time to join us today. Love the focus on the index side of the business, and look forward to seeing you out on the road.
Great. I'll look forward to seeing you as well, Joe. Thank you.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
In today's Tools, Resources, and Good Reads, we're going to take a look at the OIC's virtual trading system found on the OIC website. Start by logging into the OIC site at optionseducation.org. If you've never registered on the site, you need to do that before you can log on. Nothing to it. It'll take only a minute or two. Next, go to the Tools and Resources tab. In the drop-down menu, you'll find the Virtual Trading System, or VTS, midway down on the left side. Click that, and the screen with the button to access VTS appears. Click that Access button, and your virtual account will appear. You'll find an account with 25,000 virtual dollars. Across the top of the page, you'll find 3 tabs, one for account, one for trade, and one for quotes. When you hit the Trade tab, your virtual options order form will appear. Enter the symbol of the underlying you want to trade. You can hit the Options Chain tab as well to explore what options are offered and the various prices. You can hit the X Spreads tab, where you're able to enter all kinds of option orders, spreads, combos, straddles, butterflies, condors, in addition to straight call and put orders to buy and sell. Now, there's also a tab for covered calls, protective puts, and collars on whatever your favorite underlying issue may be. Don't hesitate to create your virtual account and begin trading options with the OIC's virtual trading system. That's today's tool. Now, today's resource is the SIFMA website. That's SIFMA.org, stands for Securities Industry and Financial Markets Association. It's a website that offers the most current topics on really all the financial markets. So check it out at SIFMA.org. And finally, our good read for today, especially for you trader types, is Jim Cramer's Confessions of a Street Addict. One of the, to me, all-time great books on, what goes on, on the trading side of the stock market. So check it out, Confessions of a Street Addict by Jim Cramer.
It's time for a nostalgia break. It's time to take a look back.
Today's Looking Back, we'll take a look at the TAB Group's recent report titled U.S. Retail Options Trading. It doesn't get any better than this. Wow, that's quite a title. U.S. Retail Options Trading. It doesn't get any better than this. Now, for those of you not familiar with the TAB Group, they're a capital markets consulting firm founded in 2003, headquartered right outside of Boston, Massachusetts, with offices in New York City and London. To quote TAB, the retail options industry has never been healthier. The industry's relentless focus on education is cited as one of the key reasons. Advancements in broker platform technology another, and lower commissions, of course, never hurt. Now, TAB estimates that retail options trading accounted for 24% of total U.S. listed options trading in 2013. Now, that's just under 4 million retail contracts a day, and that's up about 12% from 2012. TAB sees continued growth in retail volumes going forward and is projecting an additional 5% increase in retail volume in 2014. Investors have often been associated with simple option strategies like covered calls, but TAB and brokers see a trend in retail using more and more complex strategies, such as two-legged or multi-leg strategies. That's today's Looking Back, with also a forward look at retail options volume for the year ahead.
You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of The Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.